Hello and welcome to this video on exchange rates, looking at fixed, managed and floating. So in this video we're going to distinguish between floating exchange rates, managed exchange rates and fixed exchange rates, look at some of the analysis around those issues and then finish off by looking at some examples. So let's start off with what we mean by an exchange rate. Our best definition is this one here, the price of one currency in terms of another. So really looking at the price of money. So for example, the price of €1 in terms of pounds, or the price of $1 in terms of yen. Now this value is normally bought and sold, is determined, by the foreign exchange market, where currency is bought and sold. So if you want to go on holiday, you go down to your local currency dealer, you buy it from them, but they in turn would buy and sell to get the currencies from other people through a foreign exchange market, sometimes called a forex market. Now, why do we buy foreign currency? Well, if I am living in the UK and I want to buy a product from Europe, then I need to buy some euros first before I can then pay for the import from Europe. Also, if I want to build a factory in Japan, then I need to exchange. I need to sell my pounds to buy Japanese yen so I can build a factory and pay for cement and so on in Japan. Also, some people buy and sell currency to try and make a profit. So to trade currency to try and make a profit. So the price of currency, the exchange rate, is determined by demand and supply. Now traditionally, where do those demand and supply factors come from? The supply of currency on the foreign exchange market usually comes from a country's demand for imports. So as we said previously, if I'm in the UK and I want to buy something from France, I have to sell my pounds and buy euros. So that will increase the supply of pounds on the foreign exchange market. In turn, where does the demand for currency come from? Where would the demand for pounds come from? Well, demand for pounds would come from people abroad who want to buy UK exports. If they want to buy something from me in the UK, they need to pay me in pounds. So they need to buy pounds. So there's an increase in demand for pounds. And so obviously we've been looking at this from a UK perspective. So if an exchange rate is determined through imports and exports and the demand of supply of currency, we can represent what's happening to an exchange rate using a demand and supply diagram. So here on this diagram we have, first of all, on the y-axis the price, and here we have the price of pounds in terms of dollars, and on the bottom axis we have the quantity of pounds being traded. We also have the demand for pounds. When the value of a pound is very high, we have less demand. When the value of the pound is low, we might buy more pounds. And similarly, we have people who are looking to sell the pound. When the value of the pound is low, people don't want to sell very much. When the value of the pound is high, people might be looking to sell more. And where demand meets supply, our market is in equilibrium. We would have the long-term equilibrium value of a pound here at price P1. So this might say that £1 is worth $1.20. Now let's say that all of a sudden people in the UK want to buy products from America. There is an increase in the demand for imports from America in the UK. How would that affect this market? Well, if I want to buy something from America, I need to sell my pounds and I need to buy dollars. And by selling my pounds, I would increase supply in the market, which would have the effect of lowering the price to P2. So demand from imports would lower the value of the pound. Perhaps a pound would now only be worth $1.10. On the flip side, I can take this away and we can look at what might be the case if there was an increase in the demand for UK exports. Let's imagine Americans now wanted to buy cars from the UK. Now, in order to buy a car from the UK, an American person would first of all need to get their hands on pounds in order to pay the UK car seller. That extra, trying to get their hands on pounds, would increase the demand for the pound in the foreign exchange market, I would see an increase in demand. And the impact of this is that it would raise the price here to P3. So now £1 might actually be worth $1.30. So we can use demand and supply diagrams to illustrate what's happening in foreign exchange markets. Now, a floating exchange rate is one where the value of the currency is determined by the interactions of supply and demand, with no influence from the government or state. And if the value of a floating exchange rate decreases, we call that depreciation. The value weakens or goes down. If the value goes up, we call that appreciation. The currency is strengthened. We can also talk about managed exchange rates. And a managed exchange rate is one that for the majority of the time is floating, determined by buyers and sellers of currency in the market, so firms and individuals. But from time to time, occasionally the government or the state or the central bank intervene in the market to try and influence the exchange rate. So we would say they're kind of managing it, but not on a regular basis, managing it from afar. We can also talk about fixed exchange rates. The fixed exchange rate is where the rate is heavily influenced by the government through controls or interventions in the foreign exchange market. If the government decides to fix the exchange rate at a lower rate, weaken it, if the government make this decision, it's not called depreciation, it's called a devaluation. The government fixes the currency at a weaker value. If the government decides to fix the currency at a higher value, a stronger value, we call this revaluation. So the question next is, how does a government actually do this? How does a government influence the exchange rate? Well, again, we know the prices are determined through the foreign exchange market, so they have to do something that will influence the buyers and sellers in the foreign exchange market. Now, what often they can do is the central bank, so for example, the Bank of England or the European Central Bank or the Federal Reserve will have currency reserves, and they can use these reserves to influence the demand and supply of their own currency and so influence the rate. Governments can also change interest rates to influence the demand and supply of a currency. They can also introduce capital control, so limiting how much money can be converted or moved into that currency. Again, this can limit the extent to which supply and demand might shift. So why would a government want to fix or manage its exchange rates? Let's break it down into two halves. First of all, why would a government want to devalue or try and encourage a depreciation of the exchange rate? Well, a weaker currency, WIPODEC, we know would make exports cheaper, and so potentially we'd export more and we'd improve the current account position. A lower currency increases export demand and increases domestic price level by making imports more expensive, so this might reduce the risk of deflation. It might encourage an inflationary pressure. Also, this might rebalance the economy away. We might think we're very heavily reliant on domestic consumption to provide economic growth, and so this might move us more towards a more balanced makeup of aggregate demand. Why might we want to revalue or appreciate our currency? Maybe to try and reduce inflationary pressures, because essentially we're making imports cheaper, or maybe to reduce the price of imported capital and technology. So now let's look at some examples. First of all, an example of a floating exchange rate might be the pound. The UK government and state don't actively influence the rate of the pound, and so we can see here a fairly random walk that the pound has taken over this time period. Having said that, in the past the pound has at one point in time been a managed currency. In the early 1990s, the pound was managed to be a certain rate against the at the time German Deutschmark, and we can see on this diagram here the boundaries over that time period in which the exchange rate was managed up until July 1992, when the UK abandoned this policy, and you can see the exchange rate fell as it moved back to a floating exchange rate. Another example of a managed exchange rate might be the Japanese economy. It spent more than 2 trillion yen buying foreign currencies in September 2010 to try and stem a rise in the yen that had hit their export sector. So here we can see the US dollar against Japanese yen, and as the dollar has weakened against the yen here, that means that the yen is actually increasing in value. Switzerland is another example of a state that has intervened in the foreign exchange market. They've intervened on several occasions in the last few years to curb a rise in their currency because they had a fear it was damaging exports. So they often did this by intervening to lower interest rates. And again on the chart there we can see that they have attempted to lower the value of the franc. So we can see here the amount of euros needed to buy 1 franc has decreased as the Swiss government have tried to devalue their currency. An example of a fixed exchange rate might be the Chinese yuan. It's moved perhaps to more of a managed exchange rate these days, but you can see back in the late 90s and early noughties, this period here, the value is almost exactly fixed against the dollar, just over 8 Chinese yuan to 1 US dollar, and that was the Chinese government intervening in the market to maintain that value. Another example here of a fixed exchange rate is the Danish kroner against the euro. Here are the bounds that the Danish government set that the currency has to stay within, and we can see that generally speaking over time the value has been very tightly fixed against the euro. So roughly 7.45 kroner for 1 euro. So in this video we've looked at the difference between floating, managed and fixed exchange rates and some examples. That's it. Thank you very much for listening.